The U.S. markets are currently closed for trading. As of the last session's close on Thursday, October 16, 2025, Rezolve AI PLC, trading under the ticker ZONE, finished the day at $5.04 per share. This represented a significant intraday drop of $0.42, marking a steep decline of 7.69%. Now, seeing a nearly 8% drop in a single day on a recently listed tech company might immediately scream risk or failed venture, especially in this economic climate. The common expectation is that this is just another casualty of the de-SPAC fallout, a company that came to market with big promises but is now facing the harsh reality of public market scrutiny. But that's a surface-level reading. The reality of what's happening with Rezolve AI stock is far more intricate and tied to the mechanical, almost invisible pressures that follow a special-purpose acquisition company merger. That 7.69% slide isn't just about sentiment. It's a reflection of structural share dynamics that most retail investors, perhaps those making trades on the Robinhood app or through a SoFi Invest account, might not be tracking. The real story isn't just whether the company's tech is good, but whether it can survive the turbulence of its own share structure. Let's establish some common ground. The general belief circulating about stocks like ZONE is one of extreme caution. It's a growth-oriented company in the mobile commerce space, an area littered with competitors. It came public through a SPAC merger with Armada Acquisition Corp. I, a path that has, frankly, burned a lot of investors over the past few years. The expectation, therefore, is for continued volatility and a high probability of failure. However, challenging this view requires looking past the ticker's origin story and focusing on two specific things: the mechanics of its post-merger float and the quiet but tangible progress it's making in specific international markets. The market seems to be pricing ZONE based on the sins of other failed SPACs, creating a potential disconnect between its current valuation and the underlying operational substance. The difficulty for many is parsing this. While sophisticated traders using the advanced tools on a platform like Interactive Brokers might be modeling for warrant overhang and lockup expirations, the average person looking for some investment help or trying self-investing for the first time might just see a scary red number and sell. Let's dissect that recent stock movement more thoroughly. The 7.69% decline was not on unusually low volume, which tells us this wasn't just a case of a few large sell orders skewing the price. There was meaningful participation, suggesting a broader distribution of shares. What could be driving this? First, we have to consider the typical de-SPAC life cycle. After a merger is complete, there are often several overhangs. There are the initial SPAC sponsors, early investors, and company insiders who hold large blocks of shares that are subject to a lockup period, usually lasting about 6 months. As that date approaches, the market begins to anticipate a new wave of supply hitting the open market, which naturally puts downward pressure on the price. Investors who hold shares in a Fidelity brokerage account or any individual brokerage might get alerts about price movements, but not the context of these structural events. Furthermore, there are warrants. Most SPACs issue warrants alongside their shares, giving the holder the right to buy another share at a fixed price, typically $11.50. If the stock trades significantly above this price, warrants get exercised, creating new shares and diluting existing shareholders. If the stock trades below it, they can still create an overhang, as the company might try to redeem them to clean up the capital structure, a process that can be messy and confusing for the market. This complexity is why some investors prefer the simplicity of Fidelity ETFs or Fidelity mutual funds, over picking individual high-risk names like this. The recent sell-off in Zone could very well be driven by larger, more informed investors repositioning ahead of a potential lockup expiration or in response to filings related to the warrant structure. This is the kind of activity that automated platforms like Schwab Intelligent Portfolios are designed to avoid, as they typically focus on broader, more stable asset classes rather than speculative individual stocks. The challenge for anyone managing their Invest Online portfolio is to differentiate between a fundamental problem with the company and a temporary structural selling pressure. So, what does Rezolve AI PLC actually do? At its core, the company has developed a mobile engagement platform that aims to bridge the gap between physical and digital commerce. Imagine you're reading a magazine and you see a jacket you like. Instead of having to remember the brand, go to their website, and search for the item, Rezolve's technology allows you to simply point your phone's camera at the image. The app recognizes the product and immediately pulls up a screen to buy it. This scan-to-buy capability extends to almost any media: print ads, television commercials, product packaging, and even billboards. The business model is two-pronged. They offer a software-as-a-service platform for businesses to integrate this technology, and they also take a transaction fee on sales generated through their platform. They are trying to create a seamless, instantaneous point of decision and purchase. This isn't just a concept. They've established significant partnerships, particularly in Asia. They've worked with major players like Samsung and have integrations with large telecommunication companies in markets like China and India. This is a critical piece of the puzzle that the market narrative often overlooks. While investors in the West might be skeptical about changing consumer habits, the adoption of mobile-first, QR code-driven commerce is already deeply embedded in many Asian economies. The expectation is that this technology is a solution in search of a problem. But the reality in their target markets is that the problem, clunky, multi-step online checkout processes, is very real, and consumers are eager for a faster alternative. For those using investing sites to research global trends, Rezolve's focus on these specific high-growth regions is a key part of the bull thesis. Financially, the company is in a nascent stage. Like many high-growth tech firms that have recently gone public, profitability is not the immediate focus. The primary concerns are cash burn and the path to scalable revenue. The capital raised from the SPAC merger was intended to fund this growth, build out their sales infrastructure, and secure more enterprise clients. Any analysis must heavily scrutinize their balance sheet and cash flow statements in their upcoming quarterly reports. How quickly are they burning through their cash reserves? What is the customer acquisition cost, and how does it compare to the lifetime value of a client? These are the fundamental questions that will ultimately determine if the NVIDIA stock-style growth dreams can become a reality, or if the company will need to raise more capital, potentially at unfavorable terms, leading to further dilution for existing shareholders. This brings us to the future outlook, where the tension between expectation and reality becomes most pronounced. The bull case, the grand expectation, is that Rezolve successfully becomes the underlying technology for mobile-initiated transactions globally. If they can embed their SDK into the apps of major banks, retailers, and mobile carriers, they could create a powerful network effect. In this scenario, the platform becomes indispensable, generating high-margin recurring revenue and transaction fees at a massive scale. Investors buying into this vision see the current sub-$10 share price as a ground floor opportunity, a chance to own a piece of the future of commerce, similar to how early investors in Apple stock or Tesla stock were rewarded for their foresight. However, the reality check, the bear case, is formidable. First, there's competition. Tech giants with massive research budgets could easily develop competing technologies. The bigger challenge might be inertia. Are consumers and businesses truly dissatisfied enough with existing e-commerce processes to adopt a new system? Execution risk is also massive. The company needs to flawlessly manage its international expansion, navigate complex regulatory environments, and convince huge enterprise clients to integrate its technology. And all of this has to happen before the cash runs out. The persistent selling pressure from the SPAC structure only adds to this headwind, creating a difficult environment for the stock to find stable footing. Comment below if you think Rezolve's scan-to-buy tech is a genuine improvement over current e-commerce or just a gimmick. For investors considering a position, the choice of platform and strategy matters. An active trader on Interactive Brokers trading platform might try to play the volatility, buying on dips and selling on rips caused by the structural pressures. Someone using a simpler interface like the Robinhood stock trading app might be more susceptible to emotional decisions based on the sharp price swings. A long-term investor using a full-service platform like Fidelity Wealth Management or even a digital option like a SoFi robo-advisor would need to weigh the enormous potential against the very risks of a total loss. This is not a stock for the faint of heart. It's a high-stakes bet on a specific technological